Most people think they understand money because they know what a stock is. They watch the S&P 500. They hear about Apple, Nvidia, Tesla, Bitcoin, real estate prices, mortgage rates. But underneath all of that, quietly moving in the background, there is another market, a much larger market. A market that does not ask for attention, but decides almost everything. Bonds. And I know, the word sounds boring. It sounds like something your banker mentions when you are trying not to fall asleep. But here is the uncomfortable truth. If you do not understand bonds, you are only seeing the surface of money. You may understand prices, but not pressure. You may understand returns, but not risk. You may understand headlines, but not the machine behind them. Because bonds are where governments borrow, where interest rates are born, where recessions begin to whisper before the crowd hears anything. And by the end of this video, you may look at your house, your retirement account, your savings, and the economy itself a little differently. Let's start with the part most people skip, because this is where the entire thing begins to make sense. A bond is not some mysterious Wall Street product. At its core, a bond is an IOU. Someone needs money today, and they promise to pay it back later, with interest. That someone could be the US government. It could be a city. It could be a large corporation. It could be a company you have heard of your whole life. When they issue a bond, they are basically saying, "Lend me money now, and I will pay you interest over time, then give you your principal back at the end." Simple. Almost too simple, but the consequences of that simple agreement are enormous. Because once money has a price, everything else starts to adjust around it, and that price is interest. Think about your own life for a moment. If borrowing money is cheap, people buy more houses, businesses expand, investors take more risk. Stock prices often rise because the future feels easier to finance. But if borrowing money becomes expensive, everything tightens. Mortgages hurt more. Credit card debt becomes heavier. Businesses think twice before hiring. Investors start asking harder questions. Suddenly, $1 today feels very different from $1 5 years from now. That is the world of bonds speaking. Quietly, but firmly. Now when the government borrows money, it does this mostly by selling treasury bonds, bills, and notes. The names change depending on how long it takes for the government to pay the money back. Short-term debt, medium-term debt, long-term debt. But the idea is the same. The government needs money to fund spending. It collects taxes, yes. But taxes rarely cover everything, so it borrows. And people, institutions, banks, pension funds, foreign governments, insurance companies, and ordinary investors buy that debt because US government debt has historically been viewed as one of the safest places to park money. Not because it is exciting, not because it promises some wild return, but because safety has value, especially when you are managing billions of dollars or when you are 58 years old and you cannot afford to gamble the way you did at 28. This is something people over 40 understand better than most. At a certain age, you stop asking only, "How much can I make?" and you start asking, "How much can I lose if I am wrong?" That is when bonds begin to look less boring and more like the foundation under the floor. Stocks are ownership, bonds are obligation. A stock says, "Come along for the ride, and if the company does well, maybe you will benefit." A bond says, "You are owed payment before shareholders get anything." That difference matters. It matters in a calm economy, and it matters even more when things get ugly. If a company struggles, stockholders can be wiped out. Bondholders still have a legal claim. It does not mean bonds are risk-free. They are not. But they sit in a different place in the financial food chain. And this is where many people misunderstand money. They treat all investments like they are just different flavors of the same thing. Stocks, bonds, real estate, crypto, cash. But they are not the same. They respond to different forces. They carry different risks. They serve different purposes. Bonds are not just the safe one. They are the measuring stick. They help answer the question, what should money earn if you do not want to take much risk? Once you know that, you can start judging everything else more clearly. If a safe bond pays a certain yield, then a risky stock, a rental property, or a private investment needs to offer something better to justify the extra danger, stress, and uncertainty. This is why bonds affect stock prices. Not because every stock investor wakes up thinking about bonds, most do not. But big money does. Pension funds do. Banks do. Institutions do. And when safer bonds begin offering higher yields, some money leaves risky assets and moves towards safety. Why take a wild ride for a questionable return if a government bond is paying you something respectable with far less drama? That question can pull money out of stocks. It can cool housing. It can change how companies are valued. It can even change how people feel about retirement. Now, the word yield is important. A bond's yield is basically the return you can expect based on its price and interest payments. But here is the part that confuses people at first. Bond prices and bond yields move in opposite directions. When bond prices go down, yields go up. When bond prices go up, yields go down. Imagine an old bond that pays a low interest rate. Then new bonds come out paying a higher rate. Suddenly, that old bond is less attractive, so its price has to fall to make the return competitive. That falling price pushes its yield higher. Once you see that, financial news starts sounding less like noise. When you hear yields are rising, it often means bond prices are falling, borrowing costs are increasing, and investors are demanding more return to lend money. And when yields fall, it can mean investors are rushing towards safety, or expecting lower interest rates, or fearing slower growth. The bond market is not always right. No market is, but it is rarely meaningless. It is like an old mechanic listening to an engine. He may not see the problem yet, but he hears something in the sound. Bonds are often that sound. They tell you when money is getting nervous. They tell you when trust is changing. They tell you when the cost of the future is being repriced. And if you are building wealth after 40, you cannot afford to ignore the cost of the future, because your time horizon is not theoretical anymore. Retirement is not a word floating somewhere far away. It has a shape now. It has numbers. It has years. It has consequences. And bonds, boring as they seem, sit right at the center of those consequences. Now let's go one layer deeper, because this is where bonds stop being a definition and start becoming a map of the economy. When people talk about interest rates, they often imagine the Federal Reserve sitting in a room, making one decision, and then the whole financial world simply obeys. And yes, the Fed matters. A lot. But the bond market is where those expectations get tested every day. It is where investors vote with real money on what they believe inflation will do, what growth will do, what risk is worth, and what the future should cost. That sounds abstract, but it touches ordinary life in very real ways. When bond yields rise, mortgage rates often rise. When mortgage rates rise, a family that could afford a $450,000 home may suddenly only afford a $350,000 home. The house did not change. The neighborhood did not change. The kitchen did not get smaller overnight. What changed was the cost of borrowing. And that one change can cool an entire housing market. It can make sellers stubborn, buyers hesitant, builders nervous, and banks more careful. This is why someone can say home prices are too high, and someone else can say rates are too high, and both may be looking at the same problem from different sides. Bonds are underneath that conversation. They are not on the open house sign, but they are in the monthly payment. The same thing happens in the stock market. A company is often valued based on what people believe its future earnings are worth today. But when interest rates rise, the value of future money gets discounted more heavily. In plain English, a dollar a company might earn 10 years from now is not as attractive when you can earn a decent return safely today. This is why high-growth stocks can fall hard when yields rise. Not always, not perfectly, but often. The story changes. Investors stop saying, "What could this become someday?" and start asking, "What am I being paid now for the risk I am taking?" That is a very different room to be in. And if you have ever watched your retirement account move sharply and wondered, "What just happened?" The company didn't even have bad news. Sometimes the answer is not inside the company. Sometimes the answer is in the bond market. Money has a temperature. When yields are low, money gets warm. It moves around. It searches. It takes chances. People buy more speculative assets because safe returns feel too small. They stretch for income. They stretch for growth. They stretch because sitting still feels like losing. But when yields rise, money cools down. It becomes less desperate. It looks at risk and says, "Convince me." That one shift can change everything from stock valuations to real estate deals to startup funding to credit card rates. And this is why bonds are not just for people who own bonds. Even if you never buy a single treasury note in your life, the bond market is still influencing the price of your home, the rate on your loan, the value of your 401k, the cost of government debt, and the mood of the economy. It is like gravity. You do not have to understand gravity for it to affect you, but if you are building something heavy, you had better respect it. Now, there is another important piece here. Inflation. Inflation is the enemy of fixed payments. If I lend you money today and you promise to pay me back later, I care deeply about what those dollars will be worth when I get them back. If inflation is high, my future dollars buy less. So I demand a higher yield to compensate me. That is why inflation expectations matter so much in bonds. Investors are not just asking, will I get paid? They are asking, will the money I get back still have strength? That is a quiet but serious question. And anyone over 40 has felt this in some way. You may remember what groceries used to cost, what a car used to cost, what insurance used to cost. You may look at a bill today and think, when did normal life become this expensive? That is inflation speaking in household language. In the bond market, the same concern is expressed through yields. A household feels it at the checkout line. A bond investor feels it in the return they demand. Different language, same pressure. This is why bond investors watch inflation data so closely. If inflation looks persistent, they may demand higher yields. If inflation appears to cool, yields may fall. And when yields move, everything else starts adjusting. Sometimes quickly, sometimes quietly, but it adjusts. There is also something called the yield curve, and while the term sounds technical, the idea is simple. Normally, if you lend money for a longer period, you expect to earn more. Lending for 10 years should usually pay more than lending for 3 months, because more can go wrong over 10 years. But sometimes the yield curve inverts, meaning short-term yields become higher than long-term yields. That is unusual. It can signal that investors expect trouble ahead, maybe slower growth, maybe rate cuts in the future, maybe recession risk. It is not a crystal ball. Nothing is. But it is one of those signals serious people watch because it has mattered before. Think of it like a change in the weather. A dark sky does not guarantee a storm, but you would be foolish to ignore it if you were about to drive a long road. And that is really what financial maturity is. It is not pretending you can predict everything. It is learning which signs deserve respect. When you are younger, you can make mistakes and call them lessons. After 40, mistakes still teach you, but they charge more. A bad loan, a poorly timed risk, a retirement portfolio built only on excitement, these things can hurt differently when your runway is shorter. That does not mean you should live afraid. It means you should understand the ground you are walking on. Bonds help you understand that ground. They show you the cost of money. They show you how trust is priced. They show you how fear and confidence move through the system before most people notice. And once you begin to see that, you stop looking at finance like a casino full of flashing lights. You start seeing it more like plumbing. Less glamorous maybe, but much more important. Because when the pipes are under pressure, the whole house feels it. Now, one of the reasons bonds confuse people is because they are not only bought once and then quietly forgotten. There are really two worlds happening at the same time. There is the primary market, where a bond is issued for the first time, and there is the secondary market, where that bond gets bought and sold afterward. Think of it like a house. The first sale is one thing, but after that, the house can be sold again and again, and each new buyer may pay a different price depending on the neighborhood, interest rates, demand, fear, confidence, and timing. Bonds work in a similar way. The government or company borrows money when the bond is first issued, but after that, investors can trade that bond with each other. And that trading is where prices move, yields change, and the market tells us what it really thinks. This is important because many people imagine a bond as something fixed. You lend money, you receive interest, you wait. And yes, if you hold certain bonds to maturity and the issuer pays as promised, that can be true. But before maturity, the value of that bond can rise or fall, sometimes sharply. That surprises people. They hear bond and think safe. Then they look at their account during a rising rate environment and wonder why the safe part of their portfolio is down. The answer is not that bonds stopped being bonds. The answer is that interest rates changed. If you own a bond paying a lower rate and new bonds are paying more, your old bond becomes less attractive. To sell it, the price has to drop. That is not emotional. That is math. Quiet math, but math that can bruise a portfolio if you do not understand it. This is why duration matters. Duration is a measure of how sensitive a bond is to changes in interest rates. Longer-term bonds usually move more when rates change. Shorter-term bonds usually move less. A 10-year bond will generally feel rate changes more deeply than a 3-month treasury bill. And that matters because not every safe investment behaves the same way. Safety is not one single thing. There is safety from default. There is safety from price swings. There is safety from inflation. There is safety from needing your money at the wrong time. People often mix these together and then get disappointed when reality separates them. A U.S. Treasury bond may have very low default risk, but it can still lose market value if rates rise. Cash may not move much in price, but inflation can quietly eat its strength. Stocks may beat inflation over long periods, but they can fall hard when you need stability. Every asset protects you from something and exposes you to something else. That is why understanding bonds makes you more honest about money. You stop asking childish questions like, is this good or bad? And you start asking better questions. Good for what? Bad under which conditions? Safe from which danger? Risky compared to what? Those questions are not exciting, but they are the kind of questions adults ask when they have worked too hard to be careless. Now, look at who buys bonds. It is not just retirees clipping coupons in some old-fashioned image from another era. Banks buy bonds, insurance companies buy bonds, pension funds buy bonds, governments buy bonds, large institutions buy bonds because they need places to store enormous amounts of money with predictable rules. If you are an insurance company, you have future obligations. If you are a pension fund, you owe people money years from now. If you are a bank, you need liquid assets and income. Bonds help match future promises with current money. That may sound dull, but that is exactly why it matters. The serious parts of finance are often dull on the surface. They do not look like viral headlines. They look like obligations, maturity dates, risk models, cash flows, and quiet decisions made by people who cannot afford to be entertained by their own money. And then there is the government. When the government spends more than it collects in taxes, it borrows. It issues debt. But old debt also matures. That means the government must pay back bonds that are coming due, often by issuing new bonds. This is called rolling over debt. In normal times, this process is just part of the machine, but when interest rates rise, rolling over debt can become more expensive. Imagine having an old mortgage at 3% and then needing to refinance at 7%. Your house did not change, but your payment did. Governments feel a version of that too. So do corporations. Companies that borrowed cheaply years ago may face a very different world when their debt comes due. Suddenly, profits that looked comfortable start feeling thinner. Projects get delayed. Hiring slows. Expansion becomes less attractive. And all of this begins with the cost of borrowing. This is why the bond market can reveal stress before it becomes obvious in earnings reports or unemployment numbers. Debt has a calendar. It has dates. It has consequences. And when those dates arrive in a harsher interest rate environment, the truth comes due. For someone over 40, this should feel familiar. Life has its own maturities. The mortgage resets, the tuition bill arrives, the medical expense appears, retirement gets closer. The old assumption stops working. Money has dates attached to it, and dates have a way of making theories disappear. Bonds teach that lesson at the economic level. They remind us that promises are not free. Time is not free. Borrowing is not free. And when the price of time changes, everything built on borrowed money has to adjust. That includes governments. That includes companies. That includes homeowners. That includes investors. And sometimes, that includes us. There is another thing bonds teach, and it may be the most important lesson of all. Money is not just about return. Money is about trust. When you buy a bond, you are trusting someone to keep a promise. You are trusting a government to tax, manage, print, borrow, and remain stable enough to pay you back. You are trusting a company to sell enough products, manage enough debt, and survive long enough to honor its obligation. And the yield tells you something about that trust. The higher the yield, the more the market is usually saying, I need to be paid more to take this risk. That is why a bond from a strong government usually pays less than a bond from a shaky company. It is not because investors dislike higher returns. Everyone likes higher returns. But experienced investors know that a high return is often the market's polite way of warning you that something may be wrong. This is where many people get trapped. They see a yield that looks attractive and think, why wouldn't I take that? But the better question is, why is the market offering me that much? A 2% yield and a 9% yield are not just different numbers. They are different stories. One may be a quiet promise from a strong borrower. The other may be a loud promise from someone who needs to shout because trust is weaker. And after 40, you start to understand that not every loud promise deserves your attention. Some promises come dressed as opportunity, but underneath they are just risk asking to be renamed. This applies far beyond bonds. A rental property with a high projected return may be hiding repairs, vacancies, bad tenants, local decline, or too much leverage. A stock with a huge dividend may be signaling that investors doubt the dividend can last. A private investment promising big income may be selling confidence because it cannot sell safety. Bonds train your eyes to ask the right question. What risk am I being paid to carry? That question can save you from a lot of pain. Not all pain, but enough. Now, one of the most useful ideas in finance is the risk-free rate. In practice, people often use U.S. Treasury yields as a benchmark for what money can earn with very low default risk. Again, not zero risk in every sense, because inflation and price swings still exist, but low default risk. Once that benchmark changes, the whole investment world has to reprice itself. If a safe treasury is paying very little, investors may accept lower expected returns elsewhere because the alternative is weak. But if treasuries are paying more, risky investments must compete harder. Suddenly, a rental property with thin cash flow looks less attractive. A growth stock with profits far in the future looks more expensive. A business acquisition with uncertain earnings feels less compelling. The safe option has raised the bar. This is why bonds are like the quiet judge in the courtroom of money. They do not need applause. They simply set a standard, and every other asset has to make its case. This is also why people who only watch stock charts often misunderstand what is happening. They see a stock fall and assume investors hate the company. But sometimes investors do not hate the company. They just now have better alternatives. The same earnings, the same story, the same management team can be valued differently when the risk-free rate changes. It is like looking at a house in two different towns. The house may be identical, but the neighborhood changes the price. In investing, interest rates are part of the neighborhood. They determine how attractive everything else feels. And when rates move quickly, people who never paid attention to bonds suddenly feel the consequences in their portfolios. They may not know the language, but they feel the translation. Lower account balances, higher mortgage payments, tighter credit, slower deals, less confidence. This is the bond market speaking through daily life. Now let's talk about the emotional side, because this is where real money decisions are made. People like to think investing is about spreadsheets, and yes, spreadsheets matter. But fear, patience, ego, pride, regret, and exhaustion matter too. A person in their 40s, 50s, or 60s is not just investing numbers. They are investing years they cannot get back. They are investing the memory of past mistakes. They are investing the hope that they will not become a burden to their children. They are investing the quiet desire to sleep at night. Bonds, when used wisely, can serve that emotional reality. They can bring income. They can bring balance. They can reduce the need to sell stocks at the worst possible time. They can give part of a portfolio a different rhythm, but they are not magic. They must be understood. A bond fund is not the same as an individual bond held to maturity. A long-term bond is not the same as a short-term treasury bill. A corporate bond is not the same as a government bond. A high-yield bond is not just a better-paying, safe bond. It is often closer to stock-like risk wearing a more serious suit. That distinction matters. Because the greatest danger in finance is not risk itself. The greatest danger is misunderstood risk. Risk you understand can be managed. Risk you misunderstand tends to appear when you are least prepared. So when someone says, bonds are safe, pause. Ask what kind of bond. Ask how long until maturity. Ask who issued it. Ask what happens if rates rise. Ask what happens if inflation stays high. Ask whether you need the money soon. Ask whether you are buying for income, stability, speculation, or protection. These questions do not make you fearful. They make you awake. And awake is better than excited when your future is on the line. Because excitement can make you buy things you do not understand. But understanding gives you something stronger than excitement. It gives you judgment. And judgment is what separates people who merely chase money from people who learn how money actually behaves. Now, once you understand that bonds are really about time, trust, and the price of money, you start seeing the economy differently. You stop looking at headlines as isolated events. You begin to see connections. A government deficit is not just a political argument. It means more borrowing. More borrowing means more bonds being issued. More bonds being issued means the market has to absorb that debt. And if investors demand a higher return to buy it, yields can rise. When yields rise, borrowing becomes more expensive. When borrowing becomes more expensive, households, businesses, and governments all feel the pressure in different ways. This is why the bond market is not some quiet corner for conservative investors. It is the place where big promises meet reality. Every government program, every corporate expansion, every mortgage boom, every leveraged deal, every "we'll pay for it later" decision eventually has to face the cost of money. And when that cost is low, people act one way. When that cost rises, they act very differently. Think about the last decade or so. For a long time, many people got used to cheap money, low mortgage rates, easy refinancing, companies borrowing cheaply, investors paying high prices for future growth, real estate rising because monthly payments were manageable. But cheap money can make people forget that money has a price. It can make debt feel lighter than it really is. Then rates change, and suddenly the same debt feels heavier. Not because the numbers on the loan changed in the past, but because the future changed. That is the strange thing about finance. The past may be fixed, but the future keeps repricing it. A house bought at one rate feels like a different house at another rate. A company that looked strong with cheap debt may look fragile with expensive debt. A government that could borrow comfortably at low yields may face harder choices at higher yields. Bonds reveal that shift before most people want to talk about it. They are not emotional. They do not care what we wish were true. They respond to supply, demand, inflation, risk, and trust. And in that sense, the bond market can feel cold. But maybe that coldness is useful, because most people's financial lives are too emotional. They buy when everyone feels safe. They panic when everyone feels afraid. They chase whatever is being praised. They avoid whatever sounds boring. They confuse activity with intelligence. But bonds force a slower kind of thinking. They ask, what is this promise worth? How long must I wait? What could go wrong? What am I being paid for the risk? What happens if inflation is higher than expected? What happens if rates move against me? What happens if I need cash before maturity? These are grown-up questions. Not glamorous questions. Not the kind of questions that get applause. But they are the questions that protect people from mistaking motion for progress. And after 40, protection matters. Not because you should stop growing. Not because you should become overly cautious. But because losing money late in the game can affect your choices in ways that losing money young often does not. When you are 25, a bad investment may hurt your pride. When you are 55, it may change your retirement date. It may change the house you keep. It may change the help you can give your family. It may change how much freedom you actually have. That is why bonds deserve respect. They are not there to make you feel brilliant at a dinner party. They are there to help you understand the foundation. Now, some people hear this and think, so should I just buy bonds? That is not the point. The point is not to turn every investor into a bond investor. The point is to stop being blind to the market that prices everything else. You can own stocks and still understand bonds. You can buy real estate and still watch yields. You can hold cash and still understand inflation. You can be aggressive in parts of your portfolio and still respect the role of safety. Financial wisdom is not about choosing one asset and declaring it holy. It is about knowing what each asset is supposed to do. Stocks can build wealth. Real estate can create leverage and income. Cash can provide flexibility. Bonds can provide income, stability, and information. but none of them work well when misunderstood. And that is the quiet danger for many people. They do not lose money only because the market is difficult. They lose money because they bought something for the wrong reason. They bought a bond fund thinking it could not fall. They bought a high-yield bond thinking it was just a better savings account. They bought a stock thinking the company's story mattered more than interest rates. They bought a house thinking the price was everything, and the monthly payment was secondary. But the bond market reminds us that the monthly payment is often the real price. The yield is often the real message. The cost of money is often the hidden hand. And once you see the hidden hand, you cannot unsee it. You may still make mistakes, everyone does, but they will be better mistakes, more informed mistakes, mistakes made with your eyes open instead of your face, turned toward whatever headline is loudest that week. And that alone can change a financial life, not overnight, not dramatically, but quietly, over years. The same way interest works, the same way debt works, the same way wisdom works, slowly, then noticeably. If you are still here with me near the end of this video, I want to invite you to subscribe to this channel and stay with us every day. Not because I want to throw another financial opinion into your life, but because at this stage you deserve conversations about money that do not insult your intelligence. You deserve calm. You deserve clarity. You deserve someone willing to talk about the parts of finance that are not flashy, but actually matter. And if you are over 40, you already know this. The loudest advice is often not the wisest advice. So let's come back to the real point, because this is where everything starts to tie together. Bonds are not just an investment category. Bonds are a language. And once you learn the language, you begin to hear what the economy is saying before it becomes obvious to everyone else. When yields rise, the market may be saying, we need more return because inflation is stubborn, debt is heavy, or trust is weaker. When yields fall, the market may be saying, we expect slower growth, lower inflation, or more demand for safety. None of these messages are perfect. The bond market can be wrong. Investors can overreact. Institutions can misjudge the future. But the message is still worth hearing. Because when trillions of dollars move through a market, it is rarely random. There is usually a reason. Sometimes that reason is fear. Sometimes it is opportunity. Sometimes it is a quiet adjustment to something the average person will only notice months later. This is why a person who understands bonds has an advantage. Not because they can predict tomorrow morning, but because they understand the pressure underneath tomorrow morning. They know why mortgage rates move. They know why stock valuations can change even when company profits still look strong. They know why real estate can freeze, not because homes stopped being valuable, but because monthly payments became painful. They know why governments can feel trapped between spending needs and rising interest costs. They know why cash can feel safe and still lose power if inflation is eating it in silence. This kind of understanding changes your posture. You no longer need to chase every trend like it is a train leaving the station. You begin to ask slower questions. What is the cost of money right now? What is the market paying me for safety? What am I being asked to risk? What happens if rates stay higher longer than people expect? What happens if they fall? What happens if inflation does not return quietly to the old world we remember? These questions do not make you pessimistic. They make you grounded. And grounded people make better financial decisions. They do not always make perfect decisions, but they are harder to fool. That matters. Because a lot of money is lost not in obvious scams, but in half-understood opportunities. Something sounds sophisticated. Someone uses polished words. A chart looks convincing. A return looks attractive. And before you know it, you are carrying a risk you never actually agreed to carry, because you never understood it in the first place. Bonds can teach you to slow down. They teach you that every promise has a price. They teach you that time changes value. They teach you that safety is not simple. They teach you that higher return is not automatically better. Sometimes higher return is the market whispering, be careful. And that whisper is easy to miss when you are tired of working, tired of inflation, tired of watching younger people talk about getting rich overnight, tired of feeling like the financial world changed while you were busy living your life. I understand that feeling. A lot of people over 40 are not looking for fantasy. They are looking for a way to make the next 20 or 30 years less uncertain. They want to know whether they can retire, whether they can help their kids, whether they can handle a medical bill, whether they can stop worrying so much. And in that kind of life, bonds are not boring. They are part of the conversation about stability. But stability does not come from blindly buying something with the word bond attached to it. Stability comes from understanding. A short treasury bill, a long-term government bond, a corporate bond, a municipal bond, a bond fund, and a high-yield bond can all behave differently. They can all serve different purposes. One may be about preserving cash, another may be about income, another may be about taking credit risk, another may move sharply when interest rates change, another may have tax advantages depending on the investor. The name bond is just the door. You still have to look inside the room. And that is the deeper lesson here. Money punishes people who only read labels. Safe, guaranteed, passive income, high yield, retirement friendly. These words can be useful, but they can also put you to sleep. And sleeping through risk is expensive. So the next time you hear someone talk about stocks, housing, inflation, recession, mortgage rates, or retirement income, listen for the bond market behind the words. Ask what yields are doing. Ask what rates are saying. Ask whether money is becoming cheaper or more expensive. Ask whether investors are reaching for risk or running towards safety, because those questions will tell you more than most headlines. They will not make the future certain. Nothing will. But they will give you a better map. And when you are walking through the second half of your financial life, a better map is worth more than a louder voice. So when you hear the word bonds from now on, I do not want you to hear something dry, old, or distant. I want you to hear the sound of money being priced. I want you to hear governments borrowing, companies refinancing, banks adjusting, investors deciding how much trust is worth. I want you to hear the quiet machinery behind the headlines. Because stocks may get the attention, real estate may get the emotion, crypto may get the noise, but bonds tell you where the pressure is. They tell you whether money is loose or tight. They tell you whether safety is cheap or expensive. They tell you whether the future is being welcomed or feared. And once you understand that, you stop looking at the financial world like a collection of separate stories. You begin to see one connected system. The mortgage rate is connected to the bond market. The price of a stock is connected to interest rates. The value of a rental property is connected to the cost of borrowing. The strength of your cash is connected to inflation. The government budget is connected to debt. Your retirement is connected to all of it. That does not mean you need to become obsessed with every yield movement or every economic report. That would drive anyone crazy. But it does mean you should know what you are looking at. You should know that when yields rise, something is being repriced. You should know that when rates fall, something is being anticipated. You should know that a high yield is not always a gift. You should know that safety has different meanings. You should know that an investment is never just a number on a page. It is a promise, a risk, a timeline, and a price. And maybe that is the real shift. Not learning a technical definition, not memorizing bond terms so you can sound smart at a table, but becoming the kind of person who pauses before being impressed. The kind of person who asks, what am I really being paid for? The kind of person who understands that wealth is not built only by chasing return, but by respecting risk. Especially after 40. Especially when time begins to feel less endless. Especially when every decision carries more weight than it used to. There is a certain peace that comes from understanding money more deeply. Not because the world becomes simple, it does not. Not because markets become predictable, they do not. But because confusion loses some of its power over you. You can listen to the news without being pulled around by every sentence. You can look at your portfolio and ask better questions. You can think about retirement with more seriousness and less panic. You can see that bonds are not the opposite of wealth building. They are part of the structure that helps explain wealth building. They are the floor, the measurement, the quiet reference point. And sometimes the floor matters more than the furniture. A man can spend years decorating the house and never check the foundation. Then one day the walls crack and he finally realizes what was holding everything up. Bonds are part of that foundation. Not glamorous, not loud, but underneath more than most people realize. So do not dismiss them because they sound boring. Boring things can be powerful. A mortgage contract is boring until the payment changes your life. A tax bill is boring until it arrives. A A retirement statement is boring until you realize what it means. A bond is boring until you understand that it is pricing the future. And the future is not something you can afford to ignore. If this conversation helped you see money differently, follow the channel and stay with us. Share this video with 5 people who are trying to understand money beyond the surface, especially someone who is working hard, saving what they can, and wondering why the economy feels so difficult to read. And leave a sincere comment below. Tell me what part made you stop and think. Tell me if bonds still feel confusing, or if something finally clicked. And if there is another topic you want us to break down next, write it there too. Stocks, retirement, social security, real estate, inflation, cash, debt, anything that keeps showing up in your life and asking to be understood. Because money does not have to be loud to be important. And the things that control the most are often the things most people never bother to understand.